Onward to planning your tax strategy. So we're going to, in this unit here, we'll describe the importance of taxes for personal financial planning. Kind of, it goes without saying, again, income, the first stop along the way is taxes, and then consumption, then saving with that leftover piece. But keep in mind that about 1/3 of every dollar that you earn goes to pay taxes, and that's not just income taxes, sales taxes, the overall taxes in the country. It's about 33%. It's pretty close to the total national income. So again, for every we'll just say 30%, every 70 cents, every dollar that you earn, at least 33 cents goes toward taxes. So it's important to have some sort of a tax planning strategy to go along with this. And so in order to do that, of course, you have to be kind of aware, cognizant of what the current tax laws are and the regulations that affect you personally, your personal financial well-being, if you will. So most importantly is that keeping complete and appropriate tax records. It's going to be an important thing of kind of going forward. Sometimes it's not as important as others, but nonetheless is something to kind of keep in mind. So also we want to make sure that we make purchases and investment decisions that, with the tax man and, the tax person, if you will, in mind. All right. So target your planning efforts toward paying your fair share of taxes while taking advantage of tax benefits. You pay your fair share of taxes, but no more, no less, right? Okay. So there are four basic types of taxes: taxes on purchases, sales taxes, excise taxes. Excise tax would be something like if you buy a new set of tires, or if you buy a gallon of gas, etc. There would be different taxes that would be associated with it. Sales taxes and also excise taxes. Those are going above and beyond the sales tax. Property taxes, taxes on wealth, that would be in estate taxes, inheritance taxes, and taxes again on income that's earned. And that would include all your withholding taxes or your income tax, and also the payroll tax would include Social Security and Medicare. So in calculating your taxes, in this case, we're talking about income taxes, and we're specifically focusing on federal income tax. Something to keep in mind is that the TCJA, the Tax Cuts and Job Act in 2017, was signed into law, and we'll see how things kind of go going forward. If those are going to be, if they're going to be reinstated or not. Depending on typically what happens is that there are sunset laws, meaning that tax cuts expire after a certain period of time. Tax law reverts back to what it was before. Point again being is that that's something that's TBD, to be determined, right? So the first step along the way is determining what your adjusted gross income might be. Identifying your taxable income, which is net income after deductions on which income tax is actually computed. So you're adjusting your income. So you're taking out for deductions, so on and so forth to get to that point. Okay. So first thing we're looking at is what is included in income, or more to the point, what's included in gross income. Earned income includes wages, salaries, same thing basically, I guess, commissions, fees, tips, and or bonuses. Investment income is the dividends that you earn, the interest that you earn from that investment. Passive income is which you do not actually participate, like a limited partnership. If you're the silent partner, so to speak, in some business, whatever it is, a car wash, for example, where you're not you are a partner, however, you're not actively involved with that, so you're passive, receiving passive income as a result. Other income would include alimony from divorces, some sort of awards or other, lottery winnings and prizes. Okay, so lottery winnings and also gambling, gambling earnings from gambling. Okay. Types of income excluded from that income, the gross income exclusions, are not included in gross income. For example, portion of foreign income earned. You're paying taxes in France on your income. So there's you would not be paying taxes on that in the U.S. So that would be, since you're already paying taxes there, you wouldn't be taxed in the U.S. There's that aspect. It can also be tax exempt income, which income is not subject to federal income tax. So interest earned on municipal bonds, they're called state and city bonds, types of income tax later. That would be tax deferred vehicles such as individual retirement accounts, etc. Right? Deferred income. So again, we're walking through calculating these taxes. So in this case, we're looking at the adjusted gross income. It's income after certain reductions that we made. These reductions would again include those items that we've mentioned before, like IRAs or a Keogh retirement plan, alimony payments, tax deferred retirement plans are a type again of tax shelter that you're sheltering from your current taxes, not to say that you're not going to pay taxes on it, but it's going to be at a later date. Deductions, a tax deduction is the amount subtracted from the AGI or the adjusted gross income. And that's at that point when you have AGI, that's where you determine what your taxable income is. Again, we're talking about personal income taxes here. Each taxpayer can subtract the standard deduction, a set amount with no taxes, which no taxes are paid, or they can subtract the total itemized deduction from the AGI. So two different ways of looking at it, standard deduction and or it could be the itemized deduction. So again, skipping over the standard deduction, now we're moving on to the itemized deduction, not skipping over, but that's pretty straightforward. You're just taking right off the top for the standard deduction, itemized deduction, you're focusing on specific expenses if they would be incurred. In this case, we're talking about like medical or dental expenses, and anything greater than 10% of your adjusted gross income. State taxes is called SALT. It's also called SALT. State and local taxes that up to a certain amount could be deducted as well. Interest, like mortgage interest, home equity loan interest, etc. Contributions to qualified charities, losses due to theft, moving expenses, job-related and other expenses, again, greater than the 2% of your adjusted gross income. So exemptions, okay, so prior to 2018, exemption was allowed as a deduction from adjusted gross income for yourself, your spouse, and qualified dependents. With the TCJA or the Tax Cut Jobs Act, the standard deductions were increased, so it kind of took that away, all right? Qualified business income to provide a benefit to small business owners, a new provision called Section 199A permits owners of sole proprietorships, S-corps, or partnerships to deduct up to 20% of the income earned by the business from their individual return to arrive at a taxable income. After deducting amounts for exemptions, you arrive at your taxable income, which again is the amount used to determine the taxes you owe, your adjustable gross income. So again, we're talking about federal taxes here. So the tax rates using the taxable income of the appropriate tax table or schedule, there are 7 rates, 10, 15. These are percentages, right? This is the tax rates that you would be paying. 10, 15, 25, 28, etc. are marginal rates on the previous, whatever the dollar associated with that. For example, after the deductions and exemptions, a person in the 28% tax bracket pays 28 cents in taxes for every dollar of taxable income in that bracket, okay? So for the first dollar that you earn, you would be paying 10% after the your deduction, after you reduce your income by a certain amount. you would be paying at that 10% rate, and then thereafter the 15%, and then the 25%, and then finally, or not finally, but in this case, you at the 28%. So we talked about deductions. Deductions reduce your tax liability, it reduces your income in essence. So rather than, say $50,000, you have a $5,000 deductible or deduction rather, it reduces your income to $45,000. You pay taxes based upon that, as opposed to actual tax credit reduces your tax burden by this amount. So this is much more powerful than a tax deduction. Taxes that you pay, foreign taxes, child dependent care expenses, savers, adoption, the list goes on, including mortgage interest, and people that are 65 and older get there's a tax credit associated for them, etc. So tax payments and deadlines, making tax payments, withholding taxes are taken right off your initial income. Otherwise, you'd have to pay what are called estimated taxes, estimated payments on a quarterly basis to kind of keep up with that, with the other taxpayers who would be paying their taxes on their current income. You would be doing the same thing on a quarterly basis. There are various deadlines, penalties, etc., and failure to file a tax return can result in a 25% penalty in addition to the taxes owed. There are all kinds of penalties that go along with that as well. So for W-2 earners or people, that are being paid by an employer, this is the W-2 form that you would be receiving, which captures your income over a period of a year. It would be distributed to you, and within the framework of that W-2, you're going to be showing the wages, salary, etc., that was paid to you. And then it breaks out Social Security wages versus Medicare wages, and there's a distinction between the two. Sometimes, depending upon the employer, you may not be paying Social Security. It may be picked up in some, if it's a university or a college, for example, sometimes they have relationships. Typically, it's, I would say, in all cases, it would be in a public sector or employee, in terms of working for some sort of a government or nonprofit, where you might not have to pay Social Security. You would be paying into the pension fund or whatnot that would be associated with that with that jurisdiction. Anyhow, and then of course other things are recorded here as well, like the taxes that you're actually paying at the federal level and the state level, and again, Social Security that was withheld, and Medicare tax that was withheld, and other withholdings, if you will, could be pension from pensions, etc.